Well, we've got some strong employment data today ahead of tomorrow's jobs report. You mentioned ADP. Let's dive more into that. ADP's national employment report saw private sector employment jump by 497,000 jobs in June. That's way above the 220,000 estimate, with most of the jobs added in services like leisure and hospitality. The report also saw annual pay increasing 6.4% year over year. Meanwhile, there were 248,000 jobless claims during the week ending July 1st, close to a 2-year high, with most of the increases popping up in just a few states, including Michigan and New York, which could be due to annual summer retooling at auto plants. The rise in claims don't point to a major pullback in the labor market. In fact, the 4-week moving average of claims dropped by 3,500, and that came in at 253,250. Our next guest says that we could be at the risk of the Fed fund rate climbing to 7%. Climbing to 7% to 8% perhaps if the labor market doesn't slow down. Joining us now, we've got Chris Rupkey, who is the FWDBONDS Chief Economist. Chris, help us break that down even more, because that is well above what many have looked at as the terminal rate for the Fed.
Well, if you go back in history, back to 1989, and the Fed funds rate was 10% to slow the economy. Before the stock market bubble in 2000, the Fed funds rate was 6.5%. So right now, inflation is worse than it was in 2000, and it's worse than it was in 1989. So I just feel I've seen this story before. It was a long, long time ago. It was in the 80s. The Federal Reserve back in the 80s found it difficult to get the Fed funds rate high enough to slow activity, because it's kind of hard to judge what the public thinks is restrictive policy, and you get some confusion about nominal rates versus real rates. So if inflation's running about 5%, maybe the Fed funds rate, interest rate, should be a good 200 basis points above that, which would put it at 7%. I hope that's not the case, because I own a lot of Treasury bonds at lower yields, and it's going to incur some losses. But everything tells me that that pause they just did at the June meeting is going to turn out to be a mistake.
Chris, I want to quickly ask you about just your reaction to today's jobs data. The job market has just continued to hold up. I know the ADP report is private sector, but you also had jobless claims continuing just to show some strength there. What do you make of that data?
Yeah, I was a little bit shocked. I guess ADP every once in a while needs to swing for the fences and get our attention back to their index. I guess they're not selling it, but that was quite a dramatic number, 497. You add in 50,000 government jobs that we saw in the payroll jobs number a month ago. Maybe we get another blockbuster 550,000 increase tomorrow. We've seen this before, where some of the data the day before the so-called most important economic number in the world, the payroll jobs report, sometimes the data the day before steals the thunder of the actual jobs report tomorrow. So I was shocked, but it kind of tells you that the labor market's still strong. There's been no real increase in layoffs, despite some of those high-profile layoffs at tech companies. We see home prices are at a new record level. Looking at the data from Washington, new home sales have picked up. You know, how could that be with a mortgage rate of 6.7%, where, you know, a couple years ago the mortgage rate was 3%? It's just telling me that interest rates aren't slow enough to bring the economy to a stop, which is pretty much what needs to happen to try and get inflation under control. So durable goods orders, they're at record highs. None of this data looks like it should if the economy was slowing. About the only thing that's slowing right now is consumer spending. We had a big jump in January, and since that point in time, we haven't really seen that much more consumer spending. But, you know, everything else looks like the economy is pretty good. And
Uh-oh. Chris, do we have you? Okay.
To discount 25 basis point rate hike in the next 2 meetings. Yep.
Chris, it sounds like we still have you. If we can squeeze one more question in with you while connections are stable, we'd love to know how you would classify the consumer right now. We've heard some companies talk about the consumer as resilient, or their spending is resilient, and their balance sheet, the home, is healthy. How would you define the consumer in this environment?
Well, one thing, I don't think they're overburdened by consumer credit. I don't think they've taken on that much consumer credit. I see that headline saying they're burdened, but it's not that high yet to be burdened. The other thing, it's not just consumer confidence, which was better earlier the other week. It's not just confidence. It's not just the willingness of consumers to go to the shops and malls. It's also how many consumers there are with paychecks. So an important reason why consumer spending falls in real terms in recessions is rising unemployment. There's job losses. People don't spend because they can't. They've lost their jobs. So at this point, we really haven't seen a lot of people lose their jobs yet. So consumer spending, it's a little bit slower, but it's not going negative right now. So we're not near a recession yet, despite the yield curve forecasting a recession basically starting this month, July.
All right, Chris Rupkey, we will have to leave it there for today. We appreciate you for joining us. Chris Rupkey, FWDBONDS Chief Economist. Thank you so much.